We are into 1 week after Diwali, and I think the market's finally faced with what we would call a high probability, high beta move. The reason for that is ever since the high in June at 15,600, we've been tracing out what is known as an expanded flat. On India charts, I did discuss the possibility of a wedge, but that's looks like a less probability case. The good thing about an expanded flat, it allows you to get an exacting target, which means you can actually put a number to where you're initially headed. Based on this pattern, the initial fall that we saw between June and July was a wave of an expanded flat, and the entire rise from the July low was wave B. Wave B typically ends at 1.618% above 0.618% above wave A, and wave B has been exactly that size. That's the maximum we allow for such a pattern. And usually it's followed by wave C. Wave C is usually 1.618 times wave A, and it actually ends up bottoming out only below the bottom of wave A, which means wave A bottom close to 13,300, and wave C should actually end up being lower than that. In terms of an exact Fibonacci number, that means close to 12,500. Now, which in Nifty terms would be something like 3,600. Which is a pretty significant large move to expect, and because it's an expanded flat, although wave Cs don't always have to be fast, while they do involve a high degree of breadth in terms of that most stocks move together in wave Cs. In case of an expanded flat, wave Cs can be pretty fast and brutal, so I think it's going to be a knee-jerk reaction. Wave A lasted for a month, wave B lasted for almost 3 to 4 months. I think wave C could be equivalent of a month to two, which means the target of 12,500 could actually occur much sooner than expected. At this point, such a deep target might appear a little out of the whack, but that's what the Elliott wave structure is suggesting. What would happen after that, though, you might get a significant bounce from there. So, I'm not sure still whether we are out of the woods from the longer end, because I have not really changed the long-term perception, which I have said that this rally is a bear market rally. I know a lot of analyticians or people who have actually been marking the entire move from the October lows as an impulse, but I definitely don't think it's an impulse. It still looks like a complex corrective rally to me. Most of the readings I've looked at keep telling me that. And if even I'm wrong, I think the right time to judge that would be when you make it the first higher top, higher bottom formation, that you can actually think that, okay, fine, you are looking at something that's different and not just a bear rally of a larger time degree. But till that point of time, I think that's what the case is, which means in the longer run, lower targets could also be possible. But at this point of time, let's leave it to closer to 12,500, because that's also short of a 61% retracement of the entire rally since the October lows of last year, which is close to around 11,500 to 12,000. So that's where you would retrace 61% on the way down. And if those lows hold and you make a higher bottom, then it would probably make sense in trying to think whether this year's move was an impulse. But like I said, whatever I have seen does not tell me that. However, we have seen certain sectors see larger degree fifth waves being formed during this rally, but on the index itself, that doesn't seem to be the case. Having said that, I think what I mentioned in my previous video updates, it's not just going to be equities, but it's going to be an across asset class move, and this is simply because ever since we headed on the way down, I think the increasing correlation with what is happening in the currency markets seems to be quite visible. Now, of course, these correlations do not always persist, but one of the most obvious moves right now is that the dollar is probably closing in to a significant bottom. The dollar index has retraced 78.6% of the entire rally it saw last year. I did expect that it could bottom close to the 61.8% retracement mark, but it's extended to 78.6, which is also a fair retracement for wave 2, because wave 2s usually retrace the most. In fact, even they are known to retrace up to 90 to almost close to 100%. So that's normal, but since we see an ending diagonal pattern on on the dollar index, I think you're at the end of wave 2 at 78.6%. And that's similar to what I see on the rupee. The rupee seems to have bottomed out in a running triangle, and we should now start seeing wave 3 in the rupee versus the dollar, which means a period of huge depreciation for the rupee. These two views are probably contrarian to what most people in the market say, and it should also be followed by most commodity markets ending up declining at this point, and that would include the bullion and gold and silver. So I think that's been the broad view. You're going to get an asset class decline, a rally in the dollar, and probably most equities look down. We'll weigh probably close to the 11,000-12,000 mark in terms of the index, the Sensex, whether you're making a high, top or bottom in terms of a long-term bullish trend. But like I said, my reading is this has been a bear market rally, so you're going to be starting on a broader scale on the way down. What is only clear right now is that that because it's an expanded flat, wave C down, I've set a target of close to 12,500, and after that we look for a rally and see how things form out from there. That's all from this update, 25th October 2009. Thanks and good night.